The stock market is a place where people buy and sell shares of companies. These shares represent a small ownership in a company. When you own shares of a company, you are called a shareholder. The stock market allows companies to raise money and gives investors a chance to earn returns. The stock market operates through exchanges like the New York Stock Exchange, or NYSE, and NASDAQ. Companies list their shares on these exchanges. Investors then trade these shares among themselves. The price of shares can change based on various factors. The stock market is crucial for the economy. It helps businesses grow and provides a platform for investment. Understanding how it works can help you make better financial decisions. When you buy a stock, you are purchasing a piece of a company. This means you own a small part of that business and have a stake in its success. You can buy stocks through a broker who acts as a middleman between you and the stock exchange. Brokers facilitate the transaction and ensure that your order is executed smoothly. Brokers can be individuals or online platforms. Online platforms have made it easier and more accessible for everyday people to invest in the stock market. When you own stock, you can profit if the company does well. This profit can come in the form of dividends, which are payments made to shareholders or through an increase in the stock's price. Selling stocks is just as simple. You can place a sell order through your broker or online platform, and if there is a buyer, your shares will be sold. If you think the stock price will drop, you can sell your shares. This is called trading. Trading can be a way to protect your investment or to capitalize on market movements. Some people buy and sell stocks quickly to make a profit. This is known as day trading, and it requires a lot of attention and quick decision-making. Others hold on to their stocks for a long time, hoping the value will increase. This long-term strategy is often used for retirement savings or other long-term financial goals. The price of a stock is determined by supply and demand. If more people want to buy a stock than sell it, the price will go up. If many people want to buy a stock, its price goes up. This can happen if the company announces good news or if investors believe the company will do well in the future. If many want to sell, the price goes down. This can occur if the company reports bad news or if investors lose confidence in the company's future prospects. This buying and selling create the stock market's ups and downs. The stock market is dynamic and can be influenced by a variety of factors, including economic indicators, political events, and market sentiment. Stock prices change for many reasons, and understanding these can help investors make better decisions. Supply and demand is a big factor. When demand for a stock increases, its price tends to rise. If more people want to buy a stock, the price goes up. This is often driven by positive news or strong company performance. Conversely, if more people want to sell, the price goes down. This can happen due to negative news or poor earnings reports. News about a company can also affect its stock price significantly. Announcements about new products, leadership changes, or financial results can all have an impact. Good news can make prices rise, while bad news can make them fall. Investors react quickly to news, causing immediate price changes. Economic data also plays a crucial role. Reports on employment, inflation, and GDP growth can influence investor confidence. If the economy is doing well, stock prices often go up. A strong economy usually means higher corporate profits and better investment returns. If the economy is struggling, prices may go down. Economic downturns can lead to lower consumer spending and reduced business investment. Investor sentiment, or how people feel about the market, can also cause changes. Sentiment is influenced by a variety of factors, including news, economic data, and market trends. If investors are confident, prices go up. Confidence can be driven by positive earnings reports, strong economic data, or favorable market conditions. If they are worried, prices go down. Concerns about economic instability, geopolitical events, or company-specific issues can lead to selling. Different sectors of the market can also affect each other. Performance in one sector can influence investor sentiment across the market. For example, if tech stocks are doing well, it can lift the whole market. Innovations and growth in technology can boost overall market confidence. Conversely, if a major company in a sector does poorly, it can drag down related stocks. Poor performance in one area can create a ripple effect, impacting other sectors. A bull market is when stock prices are rising. One famous bull market was in the 1990s during the internet boom. Companies like Microsoft and Apple saw their stock prices soar. This period was marked by high investor confidence and economic growth. Another significant bull market occurred after the 2008 financial crisis. From 2009 to 2020, the stock market experienced consistent growth. This was due to economic recovery, low interest rates, and technological advancements. Companies like Amazon and Google led the charge. Bull markets are exciting for investors. They offer opportunities to make money and grow wealth. However, they do not last forever. Understanding when a bull market might end is crucial for investors. Section 5, Historical Market Downs, the Bear Markets. In this section, we will explore the significant downturns in the stock market, known as bear markets, and their impact on the economy and investors. A bear market is when stock prices are falling, typically by 20% or more from recent highs, and investor confidence is low. One of the most famous bear markets was during the Great Depression in the 1930s, which had a profound and lasting impact on the global economy. Stock prices fell dramatically, and many people lost their investments, leading to widespread financial hardship and economic instability. It took years for the market to recover, with gradual improvements and reforms helping to stabilize the financial system. Another notable bear market occurred during the 2008 financial crisis, which was triggered by the collapse of the housing market. The housing market collapse led to a severe downturn affecting millions of homeowners and investors. Companies went bankrupt and stock prices plummeted, causing widespread economic distress and uncertainty. It was a challenging time for investors and the economy as a whole, with many struggling to recover their losses. Bear markets can be scary, but they are a natural part of the market cycle, often followed by periods of growth and recovery. They offer opportunities to buy stocks at lower prices, which can lead to significant gains when the market rebounds. Understanding how to navigate bear markets is essential for successful investing, as it helps investors make informed decisions and manage risks effectively. Section 6, Economic Data and its Influence. Economic data is a key driver of the stock market. Reports on GDP, unemployment, and inflation can affect stock prices. For example, if GDP is growing, it suggests a healthy economy, leading to rising stock prices. Conversely, high unemployment can signal economic trouble, causing prices to drop. Central banks also play a role. They set interest rates, which can influence borrowing and spending. Lower interest rates usually boost the stock market because they make borrowing cheaper. Higher rates can have the opposite effect. Investors closely watch economic data to make informed decisions. Understanding how this data impacts the market can help you predict trends and invest wisely. Section 7. Company performance as a market driver. A company's performance significantly impacts its stock price. Earnings reports are one of the most critical indicators. These reports show how much money a company made in a specific period. Strong earnings can lead to higher stock prices, while poor earnings can cause prices to drop. Other factors include new product launches, changes in management, and mergers or acquisitions. For example, if a tech company releases a successful new gadget, its stock price may rise. Conversely, if a company faces legal issues, its stock price may fall. Investors often analyze these factors to determine a company's future performance. Understanding a company's financial health can help you make better investment decisions. Section 8. External factors affecting the market. External factors can also influence the stock market. Geopolitical events like wars or trade disputes can cause uncertainty. This uncertainty often leads to stock market volatility. For example, tensions between major economies can affect global trade, impacting stock prices. Natural disasters can also play a role. Hurricanes, earthquakes, and other events can disrupt business operations. This disruption can lead to lower stock prices for affected companies. Government policies are another external factor. Regulations, tax changes, and infrastructure projects can all impact the stock market. Understanding these external influences can help you navigate the market more effectively. Section 9. The role of investor sentiment. Investor sentiment refers to how investors feel about the market. This feeling can influence stock prices. Positive sentiment can drive prices up, while negative sentiment can cause prices to fall. For example, if investors are optimistic about the economy, they may buy more stocks, driving up prices. Social media and news outlets can shape investor sentiment. Positive news stories can boost confidence, while negative reports can create fear. Market analysts also play a role. Their reports and predictions can influence how investors feel and act. Understanding investor sentiment can help you make better investment decisions. It's important to consider not just the numbers, but also how people feel about the market. Section 10. Long-term investing versus short-term trading. There are different strategies for investing in the stock market. Long-term investing involves holding stocks for several years. This strategy relies on the belief that the market will grow over time. Long-term investors are less concerned with daily ups and downs. Short-term trading, on the other hand, involves buying and selling stocks quickly to make a profit. This strategy requires more attention and can be riskier. Traders need to be aware of market trends and news events that can affect stock prices. Both strategies have their advantages and drawbacks. Understanding your financial goals and risk tolerance can help you choose the right approach. Section 11. Why understanding the stock market matters. Understanding the stock market is important for several reasons. First, it helps you make informed investment decisions. Knowing how the market works can help you grow your wealth and achieve financial goals. Second, it allows you to manage risk. The stock market can be volatile, but understanding its mechanisms can help you navigate these ups and downs. You can make better decisions about when to buy or sell stocks. Finally, understanding the stock market is crucial for participating in the economy. As a shareholder, you have a stake in the success of companies. This participation can lead to greater financial literacy and empowerment. Knowing the stock market can improve your financial health and future.